Last month, a guy in Ohio sat down at a closing table to sign a mortgage, 30-year fixed 6.6%. He asked the loan officer a simple question: who decided 6.6? And the loan officer gave him the corporate smile and said, that's just where rates are right now. That's not an answer, that's a shrug with a lanyard, so here's the actual answer. That number wasn't picked by his bank, it wasn't picked by the Fed, it was set by a market most people have never looked at once in their entire lives. A market worth about $145 trillion bigger than every stock market on Earth combined. It decides his mortgage, your car loan, your landlord's next rent hike, whether your company can afford payroll, and whether your safe retirement fund quietly loses 17% in a single year. This isn't a video about some boring thing rich people buy. It's about the invisible machine that prices your entire life, and almost nobody understands how it works. My name is Nick, and I've spent way too much time reading about a market that has all the personality of a tax form and twice the body count. If you've ever wondered why borrowing money got brutally expensive overnight, or why safe investments stopped being safe, hit subscribe, because by the end of this video, you'll understand money better than most people with finance degrees. That's not a compliment to you. It's an insult to finance degrees. Okay, let's start stupidly simple because everyone overcomplicates this. A bond is an IOU. That's it. Somebody needs money. A government, a company, occasionally a city that wants a new stadium. It absolutely does not need. And instead of going to a bank, they borrow it from investors. You hand over, say, $1,000. They promise two things: a fixed interest payment every year called the coupon, and your $1,000 back on a specific date called maturity. So when the US government runs a deficit, and spoiler, it always runs a deficit, it sells treasuries. When Apple wants cheap cash, it sells corporate bonds. When a company with shaky finances borrows, those are junk bonds, which Wall Street politely renamed high yield because junk doesn't look great in a brochure. Now here's the part that 90% of people get wrong, and it's the single most important idea in this entire video. Let's say you buy that $1,000 bond paying 2%, you get $20 a year, fine, boring, whatever. A year later, interest rates rise and brand new bonds, same $1,000, same borrower, now pay 5%, $50 a year. Question: who's buying your bond? You walk up to an investor and say, hey, want this thing that pays $20 a year? And they say, why would I do that when the government is handing out $50 a year next door? Your bond didn't change, it's still paying exactly what it promised, but it's now the financial equivalent of a used iPhone 11, it works fine. Nobody wants it at full price. The only way to sell it is to cut the price. You drop it until that fixed $20 payment works out to roughly 5% for whoever buys it, which means selling your $1,000 bond for somewhere in the 700s. You just lost a couple $100 on the safe investment. On paper, sure. But as we're about to see, on paper has ended careers, collapsed banks, and taken down at least one world leader. So here's the rule: tattoo it somewhere. When interest rates go up, existing bond prices go down. When rates fall, existing bonds go up. They sit on opposite ends of the same lever. Every disaster in the rest of this video, every single one, is just this rule operating at a bigger and bigger scale. And the first place it shows up is in a single number that quietly runs your entire financial life. If aliens landed tomorrow and asked to see the one number that controls Earth's economy, you wouldn't show them the Dow. You'd show them the yield on the 10-year US Treasury. Right now, it's sitting around 4.5%. And here's why you should care, even if you've never bought a bond and never plan to. When a bank writes you a mortgage, it doesn't invent the rate. It looks at the 10-year Treasury and asks itself one question: why would I lend money to a random human for 30 years when I could lend it to the US government risk-free at 4.5%? The answer is it wouldn't, unless you pay more. So the bank takes that Treasury yield, adds roughly 2 percentage points for the privilege of you being a regular person who might lose your job, and that's your mortgage rate. 10-year at 4.5%, mortgages at 6.6%. That's not a coincidence. That's not literally the formula, but it's the biggest input. Back in early 2021, the 10-year was sitting near 1%, and mortgages hit 2.65%, the lowest ever recorded. People borrowed like the money was expiring. Home prices jumped 19% in a single year, against a 50-year average of about 4%. Then, the 10-year ripped higher, mortgages crossed 8% by late 2023, and the housing market basically froze mid-bite, like someone hit pause on a nature documentary. The bank didn't do that to you. The bond market did. And it doesn't stop at houses. Car loans, credit cards, student loan refinancing, the rate your city pays to build a school, the rate your employer pays to fund its expansion, all of it is priced off treasuries. When yields rise, every borrower in America gets the same rent increase at the same time. Companies that loaded up on cheap 3% debt in 2021 suddenly faced refinancing at 7%, and when your interest bill doubles, you don't write a sad LinkedIn post, you cut costs, which is a polite way of saying layoffs. A chunk of the job losses in 2023 and 2024 weren't really about the economy, like they were about the bond market quietly repricing everyone's debt. Oh, and one more party trick. The bond market predicts recessions better than basically every economist alive. Normally, lending money for 10 years pays more than lending it for 2. Longer wait, more reward. Makes sense. But occasionally that flips, and short-term bonds pay more than long-term ones. It's called an inverted yield curve, and it means investors are so nervous about the near future that they're stampeding into long-term safety. Researchers at the Fed checked the track record. That signal has correctly called every US recession since 1955, with exactly one false alarm. 9 for 9 plus 1 mulligan in the 60s. Your horoscope wishes it had that hit rate. So while CNBC argues about vibes, the bond market just quietly raises its hand and says, trouble's coming, and it is almost always right. This is why political strategist James Carville said back in the 90s that he used to want to be reincarnated as the president or the pope, but now he'd come back as the bond market because you can intimidate everybody. He wasn't joking, and in a few minutes I'll show you the bond market intimidating an entire country into firing its leader in 45 days. But first, we need to demolish the biggest lie in personal finance. Quick favor before the carnage, if this video is connecting dots for you, hit the like button. It's free, it takes a second, and it tells the algorithm that humans actually want to understand money. Okay, back to it. Here's what every financial advisor, every retirement brochure, every target date fund has told you for decades. Stocks are the risky part, bonds are the safe part. 60% stocks for growth, 40% bonds as your seatbelt. Then 2022 happened and the seatbelt strangled everybody. The Fed jacked rates from basically 0 to over 4% in 9 months to fight inflation. And remember our rule, rates up, existing bond prices down. The broadest US bond index fell 13% that year. Worst year in its entire history, going back to 1976. Long-term treasuries, the safest assets on the planet, got absolutely obliterated. Long-dated zero-coupon treasuries lost 39.2% in 2022. One researcher checked the records and found that's the worst year for those bonds going back to 1754. Not 1954, 1754. There were 13 colonies. We hadn't invented America yet, and bonds had never had a year that bad. The classic 60-40 retirement portfolio lost about 17%, because for the first time since 1974, bonds didn't cushion the stock crash, they piled on. Millions of retirees opened their statements and discovered the safe sleeve of their portfolio was the thing bleeding. So were they lied to? Sort of. Here's the nuance nobody explained. Bonds protect you from one risk, the borrower not paying you back. The US government will always pay you back, but there are 2 other risks hiding in the fine print. Inflation, which quietly shrinks what those fixed payments can buy, and the big one, interest rate risk, which is everything we just covered. And there's a number that measures exactly how exposed you are. It's called duration, and it's the most useful concept you've never heard of. Rough translation, duration tells you how much your bond drops for every 1 point rise in rates. A fund with a duration of 6 loses about 6% when rates rise 1 point. A long-term treasury fund with a duration of 17 loses about 17% per point. And in 2022, rates rose more than 4 points. Suddenly, Grandma's bond fund is moving like a tech stock, except without the upside or the fun. Now, here's where it gets cinematic, because this exact same math, this one rule started taking down bigger and bigger targets. First a bank, then a country. Watch the dominoes. Domino 1, Silicon Valley Bank, March 2023. SVB took in a flood of deposits during the tech boom and parked over $91 billion of it in long-term bonds with an average duration around 6 years. Safe assets, remember? Then rates spiked, and by the rule you now know, those bonds silently lost more than $15 billion in value. The bank wasn't gambling on crypto or meme stocks, like it bought the most boring assets in existence at the worst possible time, funded by deposits that could leave instantly. When SVB sold part of the portfolio at a $1.8 billion loss and asked investors for fresh cash, depositors panicked, and the bank went from fine to seized by regulators in about 48 hours. The 16th largest bank in America, killed by the used iPhone problem. Domino 2, the United Kingdom, September 2022. New Prime Minister Liz Truss announced £45 billion of unfunded tax cuts, and the bond market looked at the math and said, out loud, absolutely not. Investors dumped UK government bonds so hard that 30-year yields spiked more than a full percentage point in 3 days. That detonated leverage strategies inside British pension funds, which were forced to sell more bonds to raise cash, which pushed yields higher, which forced more selling. A doom loop with the entire retirement system inside it. The Bank of England had to launch emergency bond buying, later admitting some pension funds were hours from collapse. And here's my favorite economic indicator of all time. A British tabloid set up a live stream of a head of iceberg lettuce next to a photo of Truss, asking which would last longer. The lettuce won. She resigned after 45 days, the shortest premiership in British history, because the bond market fired her. Carville wasn't exaggerating. The bond market can intimidate everybody up to and including the person running a G7 country. Domino 3, the small one that says everything, Austria. In 2020, Austria sold a 100-year bond, matures in the year 2120, paying a coupon of 0.85%, and investors bought it enthusiastically. Why would anyone lock up money for a century at less than 1%? Because of where the world was at that moment. Roughly $18 trillion of bonds globally had negative yields. Investors were literally paying governments for the privilege of lending to them, the financial equivalent of tipping someone for borrowing your lawnmower. Next to that, Austria's 0.85% looked like a luxury product. Then rates normalized, the negative yield pile evaporated, and that century bond lost roughly 75% of its value from the peak. It's a rock-solid government that will absolutely pay every penny back in 2021 to the original buyer's great-grandchildren. Everyone in between owns a sovereign bond that performs like a meme stock without the Reddit memes. One rule: a portfolio, a bank, a pension system, a country. So you'd think, after all that, the biggest borrower on earth would be playing it careful right now about that. The single largest borrower in the history of money is the United States government, and his tab is currently around $39 trillion. Now, big debt numbers are basically white noise at this point, so let me give you the one stat that actually matters. This year, the US will spend over $1 trillion just on interest. Not paying down debt, not building anything, just interest. The minimum payment on the national credit card. For perspective, that's more than the entire defense budget. The United States now spends more money servicing old debt than it spends on the most expensive military in human history. Interest is now the second biggest line item in the federal budget, behind only Social Security, and on the current path, it eventually takes first place. Imagine your credit card interest costing more than your rent, and your plan is to keep the card. The bond market noticed in May 2025, Moody's, the last major rating agency still giving America a perfect score, downgraded the US. For the first time in over a century, the United States doesn't hold a top credit rating anywhere. The country didn't change overnight. The math just stopped being ignorable. Debt around 100% of GDP and climbing, deficits near 6% of GDP in a year when nothing's even technically wrong, and the customer base is getting picky. Foreign investors used to hold over half of US Treasuries back in 2008. Today it's around 30%. China's holdings are the lowest since 2008. So Washington needs to borrow more than ever, exactly while its most reliable customers are slowly backing toward the exit. What does any business do when demand softens? It offers a better deal. In bonds, a better deal means higher yields. We even got a live demonstration. In April 2025, after a chaotic tariff announcement, investors started dumping treasuries. Yields spiked, and within days the administration paused the tariffs, with the president admitting the bond market was getting, quote, a little queasy. Read that again. The policy of the world's most powerful government got reversed in under a week. Not by Congress, not by voters, and by bond traders. So why should you, a person with a normal life, care about any of this? I guess because remember the formula. Your mortgage is the 10-year Treasury plus 2. Every dollar of new debt, every downgrade, every nervous foreign investor puts a thumb on the scale that prices your house, your car, and your boss's payroll. The government's credit card bill is your interest rate, which raises the only question that actually matters. What are you supposed to do with all this? Real quick, because I get asked this constantly, Nick, how do you actually make these videos? The research, the scripting, the hooks, turning a topic as dry as bonds into something people watch for 20 minutes, that's a skill, and it's one we teach step by step inside our school community. Some of our members are already building channels doing exactly this. If that's something you've been thinking about, the link is in the description. No pressure. It'll be there when you're ready. Okay, back to your money. Quick reality check before this part. I'm not a financial advisor, and this is not financial advice. This is the stuff I genuinely wish someone had explained to me years ago, back when I thought a Treasury bill was something Congress votes on. First, stop donating money to your bank. The national average savings account pays about 0.5%. Meanwhile, 3-month Treasury bills pay around 3.7%. Money market funds pay around 4%, and the best high-yield savings accounts are right there with them. Same money, same safety, 8 times the interest. T-bills even come with a bonus. The interest is generally exempt from state income tax. Your bank is counting on you never watching a video like this one. Disappoint them. Second, know the difference between a bond and a bond fund, because it bit millions of people in 2022. If you buy an individual treasury and hold it to maturity, you get every payment plus your full principal back, guaranteed. Rates can do whatever they want. A bond fund never matures. It's a basket that's repriced every single day, which means when rates rise, the losses show up on your statement and just sit there. Neither one is wrong, but one of them can show you a minus sign on a safe investment, and you deserve to know which one you own before it happens. Third, check your duration. That number we talked about, it's listed right on your fund's fact sheet, and it's your honest risk label. Short duration, small swings. Long duration, you're making a bet on interest rates whether you meant to or not. The retirees who got crushed in 2022 weren't reckless. They just owned duration they didn't know they had. Fourth, if inflation is your nightmare, the government literally sells insurance for it. Series 1 savings bonds currently pay about 4.3% and the rate adjusts with inflation. Back in 2022, they paid 9.62% and were briefly the most exciting product in America, which tells you everything about 2022. Tips do something similar inside retirement accounts. Boring? Deeply. But boring that keeps up with your grocery bill. And fifth, watch the 10-year. Takes 5 seconds. When it climbs, mortgages, car loans, and corporate borrowing follow. When it falls hard, the market is usually bracing for trouble. It's the closest thing the economy has to a check engine light, and now you're one of the few drivers who knows what it means. Here's the thing, nobody tells you about the bond market. You've been participating in it your entire adult life. Every mortgage payment, every car loan, every dollar in your 401k's stable fund, you were always in the game. You just never got handed the rule book, and there's an entire industry that's perfectly comfortable keeping it that way. But now you know the one rule everything runs on. Rates up, prices down, and you've watched it take down a bank in 48 hours, a prime minister in 45 days, and trillions in safe retirement money. None of those people thought bonds were boring afterward. You don't need to trade bonds. You don't need a finance degree. You just need to stop being the only person at the table who doesn't know what that 6.6% means. Because the bond market is going to keep pricing your life either way. The only question is whether you can read the price tag. And if watching this made you think I could make videos like this, you probably could. The community link is in the description. I'll see you in the next one.